Let's answer some questions from the last market outlook. I don't know how far down the list I'll get. It seems like a long list this week. And I don't know that anybody really watches a 2-hour Q&A video, so I'll try to keep it short here. First question is about hedging, wondering if and how you are dealing with currency risk investing in U.S. markets. Answering it now isn't appropriate because I am converting all my Canadian to U.S. because I'm leaving Canada. But let's jump back a year when I didn't have that thought in my head where I did have to deal with having U.S. dollars. Since I'm perpetually in U.S. markets, I need U.S. dollars all the time anyway. So hedging out every dollar of it really wasn't something that I really cared to do. When I would start to hedge out is where I felt that the Canadian dollar was about to begin to strengthen, or I saw strength ahead for the Canadian dollar. Well, then I'd hedge out. And then when I felt the Canadian dollar was really strong and I didn't see much upside, I would under hedge or completely remove my hedges. But I wasn't too put out if I wasn't completely hedged, because I always need US dollars anyways, and it wasn't like I was converting them back to Canadian and then back to US and back to Canadian. They were US dollars and they stayed as US dollars. Interested in using options as stock replacements. So I am studying two techniques: synthetic longs and selling in the money puts, respective pros and cons. Well, selling in the money puts, you got to be careful there. You run a high risk of it being put to you because it's in the money. And if the time value component of it isn't big enough, you might find that after holding it for 2 weeks, it's put to you all of a sudden. So you got to be careful how deep in the money you want to sell them and how far out. Make sure you have a large enough time component that does not make it worth putting the stock to you. For the synthetic, you're going to have negative carry because the zero cost strike price is going to be set at the forward price. So if you go out a year, it will be set at the forward price of the underlying, whatever that happens to be. So you will have carry on that one. Nothing is free, right? So there's always risk in doing something. If it were me and I had my choice, I'd probably be doing 0.7, 0.75, maybe 0.8 deltas 90 days out and just keep rolling them up if the underlying keeps moving up. Managing some risk on LEHE trade. Thankfully this week there was a big move on the spread. Found it a bit maddening to try to execute a pairs trade based on the spread of two different securities. Yeah, trying to execute them separately, by the time you get one leg, the other one moves on you and you got to go chasing it. And I know what you mean by that. Basket Trader in IB, I think, can get that done for you. I know your applied series videos. Agency hedges most of the interest rate risk as the long end of the curve keeps raising. The hedges should run out at some point, leaving agency somewhat exposed again to the 10-year. True. How likely is that scenario in your opinion? I don't know. I haven't thought about it enough to put a likelihood on it. Is it a possibility? Yeah, it is. I think their hedges begin running out in 2024, on some of them 2024, 2025. That's a possibility. How likely? I don't know. Tips are often referred as effective hedges against inflation because they get repriced by the official CPI number. It's a slightly different version than the CPI number, but yes, at the moment long-term tips are yielding 2% plus CPI. Pretty appealing for conservative investors nearing retirement. Anything in tips that wouldn't pass your sniff test? You have to look at the break-even rate. So let's say you have a 10-year, and I'm going to just make numbers up, okay? Don't be commenting saying, oh, the 10-year isn't there. Let's say you have a 10-year at 4.5% and the 10-year tips is at 2%. That implies the inflation break-even is 2.5%. if you expect over the next 10 years inflation to average more than 2.5%, TIPS is the way to go. But if you expect over the next 10 years for inflation to average less than 2.5%, the nominal bond is where you want to go. So when you're looking at TIPS, it's not the idea that it is inflation protected that's important. So is the fixed coupon. The 4.5% is if you expect the break-even rate to be lower. Now you may say, well, that doesn't make any sense. Let me show you how this is done. Let's put inflation at 2%, and you have $1,000. You have the TIPS. You'll get $20, but your capital, if we say that the inflation was 2%, your capital goes to $1,020, right? And you get the $20. Here, we're just assuming par bonds here. Here you're going to get $45, but your capital stays at $1,000. But what you would do is you would take 25 off of here so that you're indifferent between the two coupons and your capital, and you reinvest the coupon. Your capital now goes to $1,025. Notice that you're further ahead. You can create your own capital appreciation by taking the excess and just putting it in to more bonds. So if you expect the inflation rate to be below the break-even rate, you should buy the nominal bond. Whenever you get a coupon, just pretend you got the real coupon, take the excess and add it to your capital. Or add 20 to your capital to replicate what the TIPS bond would do, and you'll have a $25 coupon instead of a $20 coupon for every 1,000 of par value. So it is the break-even rate that you want to pay attention to, and yeah, you gotta make a bet. Do you think that over the next 10 years inflation will be lower or higher than that 10-year break-even rate? That's a long forecast to make. Given new issuance of U.S. Treasury, you can have rising yields and money flowing into the U.S. Treasury at the same time as long as supply exceeds demand. True, you can if you have issuance every day, right? When issuance happens, supply hits the market, and that supply has to be absorbed. But if you don't have issuance every day, and let's say Thursday, Friday, you have no issuance, and yields go up, and yields go up, and there's no issuance. Monday, Tuesday are T-bills, and yields go up, and yields go up. It's, okay, well, I know there's no issuance at the long end of the curve, and they're still selling off. So it's not an overwhelming of supply at that point because, well, there's no issuance. There is no supply. So, yes, it is a part of the story, but it's not the story. The issuance may contribute to rising yields, but it doesn't explain the strength of the U.S. dollar. If the U.S. dollar is increasing, that means money is coming into the country. I get what you're saying is that the increased issuance may be driving yields up, and money is coming into the country to buy those bonds at the higher yields and only bidding for the higher yields, but it just doesn't seem like the whole story. But it is part of a reason, sure. If you do end up moving to a country without a tax treaty, how will the extra penalty on stock dividends and ETF distributions affect your trading? It will not. It will not. So I have a significantly high tax rate right now. So if you tell me on interest that my tax rate will go from 53.5% to 30%, thank you. On dividends, if the U.S. sends me $100 in dividends, I actually receive 85, and I have to claim that as my income. So right away I lose 15%, and I think on dividends, U.S. dividends, it comes to around 40% that I pay. So there's another $34 I lose. I'm down to 51, basically giving me a 49% tax rate. So you want to take 30? Either way, I come out ahead. Capital gains, there's no withholding on capital gains. Bonds, buy low coupon bonds. You'll still get the same yield, just you'll get the rest of it in capital appreciation. Just buy low coupon bonds. There's lots of tax-efficient strategies. Buy strips. Strips don't have a coupon. No withholding there. Just buy strips. I don't think there's withholding. I don't think when you receive the principal, there's a withholding on the principal because they'd have to know at what price you bought it at. So you can buy zero coupon bonds. You can buy T-bills, which you buy at a discount, mature at par. You could buy long-term low coupon bonds. There's lots of ways that you can implement a tax-efficient strategy in bonds. Same with holding securities. Is you can opt for a low dividend paying security in an industry. So you can look at REITs, for example, and you could say, well, most people reach for the highest yield. It's not always the most effective because every time they need to grow, they issue more shares. Sometimes it's better to find a yield that's in the middle of the pack or near the lower end of the pack because they retain more of their income to grow. So there's a higher possibility of capital gain. So there's always ways to implement tax efficiency. If I make a 10% return and my portfolio has a 3% cash yield, which would be considered high if you have a 60-40. Let's see, considered high. If there's 30% withholding, that's 90 basis points. So 10% return, 90 basis points in tax, that's 9% tax. I'll take it. Ford and GM, Stellantis, completely different story, much cheaper. All right, so you're making a case for Stellantis. No, there's not a question in there, more of a statement about Stellantis. Let's see, Iron Condor on ES. I don't like these options, these complex options trades. Took the long, okay, so you did something here, paid off, okay, similar conclusion on NVIDIA's earnings. Where's the question? Do you think there's an opportunity here on short-dated options on NVIDIA's earnings? I don't know. That's a gamble. You're betting on an event with high risk. This is not a low-risk event. I mean, if they hit it, it's going up. If they miss it, it's going down. I don't see them reporting earnings in the market going, oh, okay, that's not bad. All right. And then it just continuing on from where it is with a $3 or $4 move the next day, and everyone's saying, "Oh, okay, that's pretty good." It's going somewhere, and I have no idea where it's going. No one knows where it's going. No one has any idea. You're gonna say, "Oh, I think it's doing this. I think it's doing that." Oh, based on what it says, it's more likely to. Everyone has an opinion, but it's an event, and if it misses, that's it. If it hits, up you go. To put a complex trade on, especially if you have any short call in there at all, I would think, I know you have the long call and the short call, so you have two spreads, but it's a gamble. I mean, you have to recognize that you're making a true bet. This is not an investment. There's nothing here other than you want to be in on something that moves. Horse racing, casino, scratch and win tickets, to me, they all sound like the same thing. So I don't know that I'm the right person to ask on this because I don't know that I would ever trade an event. And I don't know that I would ever trade a high-risk binary event like this. So I'm the wrong person to ask, especially overlaying that with a four-legged option strategy. Money now exiting from long-duration bonds, entering short-term. No, I didn't mention that that's what's going on. I put that forward as a possibility, saying maybe it's going in a money market, right? You also mentioned that in case of instability, U.S. Treasuries are in demand. Why would money, in case of crisis, enter long duration and not to money markets or 12? It'll go in all across the curve. It just, if you think that something is going to happen, that the central bank will have to lower rates, the best exposure to that is duration. The best upside to that is duration, not a 3-month T-bill or a 1-year T-bill, but duration. Let's see. Rising tips are the top story everywhere. May I ask what we might do in the scenario that U.S. stops being financial hub it is? Ooh, well, that is a long ways away. It wouldn't happen overnight. You'd hear about it over a long period of time. I just don't see it. Something that would take years, maybe decades to happen, but with rising bricks and fast adjustment in today's markets, wouldn't that be something we might need to consider if it starts getting traction? Years. You'll see this coming a long way off. Right now, there's wisps of smoke on the horizon. It's going to be a long period of time. I think that any process like that would outlive you, even if you're 30. I think it would outlive you. This is not something that is on my list of things that I want to start caring about. That's me. I seem to think it would take either a big jarring event or it's going to take a long time to get there. If I were to transfer gains from my margin account to my tax-exempt account using two separate positions in options, can you use options in your tax-exempted account? I don't think so. That have a net payoff of 0. How can I minimize the effect of volatility? The effect of volatility where? I mean, if you're long in one account and short in the other account on a total portfolio basis, that position has 0 volatility. Would it be smarter to just go long the stock in one account, short in the other? So you're trying to overcommit to your tax-exempt account. I get that. I mean, it's you can buy a stock in your tax-exempt account and short that same stock in your taxable account, so that you won't lose money no matter what happens. So if the stock goes down, too bad for your tax-exempt account because you're pulling money out, but you're creating a capital loss in your taxable account. And if it goes up, you're creating a capital gain in your taxable account if it goes down. If it goes up, because you're short, you'll create a capital loss, but you will, in effect, have contributed to your tax-free portfolio with no risk and none of your own cash. I get that strategy. I'm not sure if you can get that done with the same broker. Like if you have your tax-free account and your taxable account with the same broker, at least in Canada, you can't get that done. It's called a box trade. You can't get that done. That's illegal. Because you can get that done, because you can do stuff like that. So let's say that I was getting close to retirement and I wanted to pull my money out of my RRSP without paying tax on it. I just want to pay capital gains. I don't want to take it out at my income tax rate. What I can do is find really crappy stocks, Let's say this is my tax deferred account. This is why it's illegal in Canada. But if you have different brokers, neither broker knows what you're doing. Tax deferred account, buy really crappy stocks. You know what I'm saying? And in your taxable account, short them. And if these fall, your gain shows up here and you have a loss over here, less money to take out at your marginal tax rate. And this is taxed as a capital gain, which is half of what you'd pay over here. So there is a way to shift between them, but I do believe you need separate brokers to get that done. That you'd have to have your taxable account at one broker and your tax-free account at another broker, so that their compliance department doesn't say, whoa, what's this guy think he's doing? Now, if it doesn't work out and the shitty stocks go way up, well, you made money over here and you lost money over here, but now you have a taxable loss that you can offset some of your capital gains for and get a tax benefit for it, but you haven't lost a penny of wealth. It just happens to be over here now, right? So it's kind of interesting to get done. If you can get it done, I believe you need, at least in Canada, you need separate brokers for that. However, be careful. Be careful. If you have a $1 million tax deferred account and over 8 months you suddenly get that down to $200,000, and you're claiming this huge capital gain on the other side, there might be some questions asked, right? And that would be against the spirit of what these accounts are for. But if you do it over a period of years, there's no crime in being a bad stock picker, right? Is there a rule of thumb or mathematical way to calculate the price of TLT and yield at that price? Well, you can look at the dividend. It's hard to figure out what the dividend is because it is variable. It is variable from month to month. But it's about 100 basis points lower than where the 25-year bond would be. Why do I say the 25-year? Because the average maturity of their bonds is 25 years. So if you want to match their duration, look at the 25-year bond. TLT yields to you about 100 basis points less. It has a duration of 17.6, so you can figure out the change. The TLT will reflect the NAV of what it's holding. It's holding bonds, not futures. It's holding bonds. You can look at its duration, and then you could just look at, well, you can't look at the futures. You have to look at an actual bond. Just put a bond quote up, and you can look at the change in yield on a daily basis. You can put a chart of the yield up. You can see it, and TLT should reflect, the NAV should reflect that change. So if it changes, let's say a 25-year bond changes by 5 basis points. Well, if you have the duration and the change in yield, you can calculate what the change in their NAV would be on a percentage basis. You get the change in TLT, but here's my question. Why? So you can do that, but I'm not sure why. What alpha does that give you? What extra insight does it give you to be able to do that? You're still, rather than predicting the price of TLT, you're now trying to predict the price of the bond. You're just 1 point removed, but you still have no further insight. So I'm not sure what value it would give you. I'd like to know what the yield would be when TLT is 90, 87, 85, and so on. Well, again, TLT is the yield will be based on the dividend that it pays. You can use, let's say, the last 3 months and annualize it. I think that would be close to what you would get as far as the dividend, then just divided by the new price. There is an article in CFA blog about 60-40 portfolio in the past decade shows underperformance versus 100% equity. I think the reasoning is that now 60-40 makes sense due to the high interest rates. Well, maybe in 2020 it made no sense. As a follow, would you reallocate into 100% of equities if interest rates drop 200-300 points? Yes, I would. Once I get the duration kicker out of the bonds, I would seem to think that, if rates get cut, here's the thing. It depends on what breaks. If something really significant breaks, and there's just central bank meeting after central bank meeting, and this central bank's coordinating with that central bank, swap lines are open, and they're communicating daily, and you have intermeeting rate cuts, then something big is broken, then I would probably wait till they brought rates down to under 2%, under 1%. But if they just start cutting rates because the economy starts tipping over a little bit, then yeah, I'd wait for the kicker on duration, which is what I'm waiting for. Then at that point, it would be like, okay, well, where do I want to go now? And it would also depend on the extent of the equity pullback. But yeah, I would go back into equities. I'm not moving into bonds and saying, okay, fellas, this old man's retiring. I'm going to move into bonds. I'm done now. I just think it's the right place to be. It's the right place to be now, and based on the fact that I'm leaving Canada and I have to, I'm moving everything to the U.S. in terms of the investments. Even though I'm not moving to the U.S., I have to move out of the Canadian assets I hold and into U.S. dollars. And Treasuries transfer easy. They transfer easy, so I may as well just sit in Treasuries. Looking for ways to get exposure for long-term bonds and found TMF. Why not just buy a long-term bond? It's a 3x bull lever. Okay, end of that. No, 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 no. No, no. These are daily returns. You're going to get murdered on that thing. Yeah. I'm just going to stop right there. Just buy a bond. You already have duration in the bond. Just buy a bond. Just buy a bond. Or if you want leverage, never mind 3 times leverage. Get real leverage. Use Treasury futures. There you go. Play with the big boys. Use Treasury futures, and you'll have leverage. More than 3. 2 questions. Which are the current arguments in favor against the home builders? In favor, high rates, low supply of existing homes. Against, high rates, mortgages over 7%. At the margin, that's going to take away some of the market that they, the demand that they have had over the last, 6-7 months. Should Ford GM bondholders worry about this situation, or does this matter for equity holders? More so for equity holders. When you look at debt, you got to look at net debt. There's too much focus on this company has this much debt. Yeah, but they got this much cash, right? You got to look at net debt. That if they took all the cash and they paid off the debt, how much debt did they have? And for some companies that have debt, they have way more cash than they have debt. So right now, cash is paying, 5.5%? And let's say the weighted average interest on their debt, being corporate debt, is 5.5%. Debt's free. I mean, at that point, there's, who cares, right? You got to look at the net debt. No, equity holders will always be in a riskier position than bondholders. You could never get to a point where you would say, oh no, equity holders are going to be fine. It's the bondholders that are in trouble. If the bondholders are in trouble, equity holders are wiped out. Period. Let's assume you have a short put that has gone down in the money and that you don't want it assigned to you. Little time value left. Probably looking to roll it out and down. Yep. There are still a few months left to expiration, so there's plenty of time value left in this short put. Yeah, but if you roll it forward and down, you'll still get lots of time value on the next one. It's relative, right? If there's a lot of time value in this one, the next one will also have a lot of time value. If you wait for this one to have a little time value, then the next one will have less time value as well. You fear that it might continue going down, dipping further into the money against you before expiration. So here's the thing. When you first opened the put, maybe you had a delta of 0.4. Get back to that. Period. A preservation of capital is much more important than return on capital. So if you have a rebalancing limit where you say, okay, I sold a put at 0.2 delta. Once it gets to 0.4 delta, I'm going to go back to 0.2 delta. If you want to get your delta down, you don't want to roll forward and down. You don't want to do something like that. If your delta is 0.6 and you don't like a delta of 0.6, you want a delta of 0.2, short 20 shares. Just short 20 shares. If it goes back up, you only have 20 shares that are going to work against you, right? So that you can handle at some other time, but just hedge out. Get your delta back to a level that you don't mind, or roll forward and down, or just exit. 2, seems like the raise of the long end of the curve is where all eyes are on. Yep. Macro pundits point to yen and yuan weakness as reasons for those countries to further sell their U.S. Treasury bond reserves in exchange of dollars to defend their local currencies. Well, yeah, that's the thing with Japan, right? Could be. And that's the risk. That is a big risk. So this week in the applied series, the portfolio management series, we're going to do a carry trade. I'm going to show you how to use the yen to buy a money market fund. Here, why a money market fund? Because the size of the trade we're going to make on a paper account, there isn't enough depth at the offer to buy the T-bills or the treasuries we need. So we have to use something else. So we're going to use a money market fund which holds its value very close to $50. But we're going to do a carry trade. The big risk of the carry trade is the yen strengthening. Always the biggest risk of the carry trade. So let's put our nerves on the line and let's do it with the yen. So I'll show you how to get that done. Buying money market funds with borrowed money, and a lot of it too. A lot of it. We're going to do a big trade, and then we're going to put that money into subsecurity. It's better if we could put it in bonds. But there just isn't the liquidity. The paper account won't let us get it done. So, but if we're thinking about Japan trying to protect its currency, yeah, you're right. When it gets to this level, they may need to protect their currency. However, they would not need that much. They could probably get it done with maybe 20 billion, 30 billion. And they would more than likely, we don't know where they're holding on the curve. They're less likely to take a loss, or I'd say almost not likely to take a loss. They would probably use bonds that they're holding that are going to mature soon, or T-bills, or whatever the case is, but they would start at the closest maturity first, being that the market value of their bonds are probably below where they paid. So they're not going to want to take a loss. But yeah, it wouldn't take much to get done, and you just need to scare people when you're defending your currency. You just need to cause those that are in the carry trade to fold, and they'll start carrying the rest of the currency for you. On top of that, the Treasury says that they're ramping up issuance over the following months. We all know that whenever hell breaks loose, T-bonds will catch a bid, flight to safety. But until then, do you see the long end of the curve closing into 5? Here's the thing. I hope so. Yesterday, I closed some TLT and went right into the 25-year bond because I can realize a loss on TLT right away, and I can go into bonds. So it's a tax-efficient move for me to make. Plus, I get 100. It was like 110 extra basis points over what TLT would pay. I'm kind of hoping it keeps going. At this point, I'm saying this is great because I can move my TLT all into the long bond by selling, realizing the loss, having a nice low tax year this year, and moving that loss, in other words, realizing the loss and moving it over to the long bond. Do you get that? So I'm not really taking the loss. I'm just shifting it over to another security. I'd still be underwater on the long bond because of where TLT was assigned, but I'd be realizing a loss, so the tax benefit for me would be incredible. So I'm kind of hoping it will. I was hoping for more today, but the bond rallied today, TLT rallied. Oh, well, okay, then I'll wait. But I will slowly move everything into that long bond. So for me, I hope it does. I hope it gets to 5%. I bought yesterday at 4.6, the 25-year now, 4.61, 4.62%. Yeah, so I can handle more. I'm good with that. I bought at 76.15. Bought the 25-year, the 2048. I'll write it out for you, just so that you know what I'm talking about. I went out to 2048 the August. It's the August 2048 bond. It's a 3% coupon. I got it at 76.15. In other words, this is 76.15% of face value. So basically, I'm paying $761.50 for a bond that will give me $1,000 on 2048 plus 3% per year. Has a duration of about 17 and a half. Okay. Elaborate on wanting more duration when the yield is anticipated to decrease. Well, duration is a sensitivity. Duration measures the percent. If you have a duration of, let's say, 10, That means it is 10%. The value of your holdings will rise 10% for every 100 basis points that the yield drops. Let's see. What is your outlook on Canadian real estate? I think it's tight. I think it's tough. I saw a headline today. There's one research firm, or I think it's one of the banks, is calling Canadian real estate the biggest bubble of all time. I think they're right. I see through Reddit, Twitter, a lot of homeowners are struggling to keep up with their variable mortgages. Now BC has raised property tax, and that's another thing. Property tax is going up. Yeah, it's a problem. But the level of immigration we have is going to keep property prices high for some time because we have a shortage. We have a shortage of housing, and we have more people coming in than we can build houses for. Just to keep up, we have more people coming in than we could build houses for, and new family formation faster than you can build houses for. Where are they going to go? This week, our Liberal government, which is very rare for our Liberal government, very rare, is entertaining the idea of lowering the number of international students that come into the country for school because there's no place for them to live. Our Liberals are doing that. Now, when the Liberals get to that point, you know there's a problem. You know that, because usually they ignore everything and they just do things that look good, which is now stupid. And here's why it's stupid. International students pay for everything. They are profitable to our higher education system because there is no government support required for an international student. They pay the highest tuition rates to be here. So by limiting the number coming in, you're asking the taxpayer dollars to pick up the slack for all of that, and somehow this is magically going to fix everything by taking more money away from people. Liberals, I think it's time that we all recognize that this Liberal experiment has failed. They've had their time in the sun. We've let them do it, but I think it's time to recognize that it has failed. But yeah, that is a big issue in Canada. A big reason is a lot of regulation. You know, well, you can't build here and you can't build there, and there's some land here, but I see some natural water on this land. That's a natural wetland. There's a frog in there. You can't build there. You can't tear down this tree. You can't do this. You can't do that. In this region, you buy 25 acres. And God forbid that there's standing water on that property because somebody comes in and says, that's natural water. That's a wetland. You can't touch that. You can't touch it. You can't cut down that tree. You can't do this. There's a snake over there. This is its habitat. No. Sorry, can't touch that. Don't even think about relocating that frog or that snake. Don't even think about it. The regulations you have to go through. You buy a 25-acre piece of land here, it could be 2 years to 3 years before you can start servicing it. And, you know, what can you do when faced with that, right? And now you have high interest rates so that builders can't afford to float a piece of property, a 25-acre property, for 2-3 years to get it through the permitting process, because when you're buying a piece of land, your bank says, whoa, land is a very different thing than property. You got to come up with that money yourself. Well, what's the opportunity cost of getting that done? It's just a terrible situation that we're in at this point. This is why I think the Bank of Canada is stuck. I don't think it can raise rates even if it wants to raise rates. You're going to hurt a lot of people. And every day you have people walking into the bank because their 5-year term on their 25-year mortgage is done and they got to renew their mortgage. Everyone in Canada has a variable rate. Some people have a variable rate where every month their mortgage rate changes, but the most you have a 5-year rate that you fixed rate for 5, you got to go back. Variable, right? I think it's pretty bad. But there again, with this many people coming in, I think it supports prices for a while, because where are you going to go? Where are these people going to go? Onto the streets? Can't go on the streets. You got to go somewhere. You have to go somewhere, and that's really what is supporting housing right now. I know you've touched on this in the past, but with the yield curve being so important at this moment, could you explain why the 20-year U.S. yield is about 20 basis points higher than 30? On the yield curve, we do have something called the clientele effect, right? To explain the shape of the yield curve, one of the theories is the clientele effect. Clientele, right? That there are some types of firms that live at the 10-year. There are some that live at the 20-year, and there are some that live at the 30-year. So you can think of insurance companies, life insurance companies over here. Big hedging instrument over here. It's not a, there's not a lot of excitement over there because, well, if I'm over here, I must be looking for duration. Why not grab this? If I'm not looking for duration, well, this is far more liquid. So it has a very low clientele effect. There's just not a lot of excitement for that one. So if you are okay with a 20-year bond, it does offer a higher yield. It is less liquid, mind you, but it does offer a higher yield. As a Canadian resident who wants to invest in the U.S. using a passive strategy, do you see any difference in investing via ETFs? Okay. Do you think it is wise for a small retail investor to convert CAD to US using IBKR? Well, yeah. You're going to get the spot rate. You're never going to get a better exchange rate than with IBKR in terms of, versus the bank. When I say you'll never get a better exchange rate, it's not like IBKR will give you the best exchange rate. It'll give you the spot rate, whatever the spot rate is, but you'll never get better than the spot with anybody else. Will the commissions and currency movement eat into the return in the long run? And not the commissions. Commissions are almost nothing. You can just ignore the commissions. Currency movement, potentially. Or the Canadian can really weaken from 135.5 to 145. Where it probably more rightly belongs given the level of debt that we have and the looming, I think, crisis that we have coming. I think our currency rightly belongs around 145 instead of 135, but that's just me. It could go to 125. I mean, this year seems to be the year of low probability outcomes being the outcome that actually happens. It could. Whenever you take on different currencies, you take on currency risk, right? Indicators are pointing towards resiliency. Does that bring in a possibility towards inflation picking back up and the Fed having to move higher? When you say possibility, yeah, of course it does. It brings in the possibility. There's always the possibility of that. What the probability is, I don't know. Seeing someone else experience the same situation. I sold a put spread on TLT and it went straight down through my spread the moment I sold it. From the other side, I've exercised in the money side today. Feels like the Matrix, where everything is just waiting to duck you up. We cannot both be in the Matrix, right? Right? Well, yeah. It does feel like sometimes, when I do something, the universe just can't wait to punch me in the face. And it's just been that year. Every now and then you have a period of time where it seems like everywhere you go to hide, the universe finds you. It's beta and duration have been really tough to get straight this year. Currencies have been easier. The micro plays that I've been making, the individual stock names have been working out great. Thank God for the Canadian move. I put everything in, changed everything to US at just a little under 132. We're sitting at 135.5 now. That really made up for beta. But here we are with duration, right? And here's the one thing I know with duration. I can't lose. I cannot lose because I am willing to hold these. I'm okay with the yield. I'm willing to hold them, and I need to be in US dollars anyways, and I'm not just going to sit in cash. So I do have barbell strategy in the sense that I got a lot of T-bills and I got a lot of the 25-year bond. So it's kind of helping me out in that sense. And if I'm willing to hold those 25-year bonds, I cannot lose. This is one of those things, like you buy the market at 4,500 and the market goes down, you don't know how long it'll be before it gets back to 4,500, if it ever does. It could be one of those 20-year things. But with these bonds, I know I know I can't lose. They will amortize themselves to par over time. I'm good. Can you explain how does the interbank rate and central bank interest rate? No, explain. That's a long explanation. Why all the current Euribor rates and lower ECB interest rates, but the rates in every country will reflect the rates in those countries. So in the U.S. you have SOFR, the secured overnight funding rate, which is secured by T-bills. So it will reflect the T-bill rate. It'll be very close to that because it's almost like a proxy for the T-bill rate, on the recognition that it's not a government interest rate, it is an interbank interest rate. But for me to begin to explain that, I would first have to ask you, do you have 15 or 20 hours? Because it's a long explanation with a lot of detail. It can be confusing, all these rates everywhere, but there is a lot of structure and logic to it. But it's nothing that I can tell you in the next 3 or 4 minutes and you go, oh, I get it all. It's all connected, and it's kind of separate, which probably just confuses you even more. Question I have stems from a question someone asked on your last video about the stock forward price. The stock forward price that the normal distribution for the options is based on. S9. Well, you're right about using continuous compounding, as long as your R is in continuous compounding. To really see why the interest rate matters and why it's centered around the forward rate, you have to look at D1. And ND1 is just a cumulative distribution. It goes from 0. A D1 will go from 0 to 1. So an ND1 of 0.5 would represent on the distribution 50%. It would be this much of the distribution, which should be an at the money put. You get at the money. You get D1 equal to 0.5 when S equals X and R equals 0. When you have extremely low interest rates, you'll have a mathematical relationship between time and volatility, such that the shorter the period of time, the closer you'll be to 0.5. And with higher volatility, you'll be slightly higher than 0.5, just slightly higher than 0.5. Where things get really bad is where the interest rate increases. So the first term of D1 is S over X. And let's let S equal X. This term will equal 0. Plus R minus Q plus the variance multiplied by T over sigma times the square root of T. So we know that this term equals 0. S equals X, meaning your strike price is at the stock price. You're thinking about an at-the-money option, right? R minus Q. This is continuously compounded interest rate, continuously compounded dividend yield, continuously compounded. So let's say your T is 1 year. Let's just make it really simple. You're doing a 1 year option. This will be a 1 year, whatever the 1 year rate is, quoted as continuously compounded. And this will be your dividend yield, quoted continuously compounded. If you have no dividend yield, notice that up here, this and this will have a relationship that can mathematically be solved, but R will simply move your D1 higher above 0.5, so that if you had a stock price that looked like this, by the time you found the at-the-money price, it would be very close to what calculating a forward price on this would be using the continuously compounded rate. But as the interest rate drops to 0, this is what happens to the forward price, right? And if R equals Q, in other words, the continuously compounded discount rate, the continuously compounded dividend rate equals the continuously compounded interest rate, what you can get is an at-the-money option 1 year out that's very close to at-the-money today, except you give up your entire dividend yield. because the dividend yield at 0%, at 0% interest, the dividend yield would be in the options. You would have a strike price at the money that is lower. That is lower. So this is where R really gets you, is that it raises where the at the money happens to be. The higher R goes, the lower Q is. The more, if there is no Q and there's just R, the more it begins to approach what a forward price would be. Yes. But yes, you did that right. Continuously compounded. You did that right. China slashing holdings of U.S. Treasury 14-year lows, likely keeping the U.S. reserves for now. And that's what you got to do, right? You got to sell your treasuries, but not sell your U.S. dollars. Well, okay, so the U.S. dollar wouldn't go down, but that doesn't explain why it's going up, right? You have the U.S. dollar going up, which means money's coming into the country, but you have yields going up, and you have stock markets going down. So money is clearly leaving the stock market. You have Treasury yields going down, so we can say, okay, well, maybe there's just a lot of supply sucking up some money, but there's not supply every day, and yields go up every day, so it appears you have some money leaving the bond market. If we accept that China is selling something in the bond market, money's leaving the bond market, but the U.S. dollar is getting stronger. Once you sell your U.S. Treasuries and you're leaving your money in U.S. dollars, what are you putting it in? There's not a pile of cash sitting somewhere on a shelf. It has to go into something somewhere. It must go somewhere. And if you say, well, what if they just leave it in a bank account? Then the bank would put it in something. If it's sitting in a bank account as a deposit, the bank will then put it in some asset, usually a money market security or some kind of low risk security. It will put it in something. It must go somewhere. I'm puzzled. U.S. dollar going up, meaning there's an inflow into the U.S. of money, but it's flowing out of equities and it's flowing out of bonds. Where the hell is it going? That's, there's lots of little things like, well, it could be this and it could be that. It doesn't explain all three things. Yeah, you could explain, well, there's an issuance of treasuries. There's a lot of issuance of treasuries. That could explain higher yields. But it doesn't explain the rising U.S. dollar. Because if money's coming into the U.S., it's got to go somewhere. It doesn't just end up in a bag on a shelf in a building somewhere. It sits in a financial asset somewhere. Where the hell is it going? That's my puzzle. How do you imagine commercial loans may impact corporate balance sheets? And by extension, the stock market. Well, when you say commercial loans impacting corporate balance sheets, banks make loans, corporations receive the loans. Are you talking about bank balance sheets, or are you talking about corporations who receive the loans sitting on their balance sheet? I don't know that that so much affects a balance sheet as an income statement, because you got to make the interest payment. So I'm not sure what you mean here. And by extension, the stock market. So I'm not sure if you mean banks or if you mean corporations. So I'll pass on that. Companies still increasing capex and using their cash instead of debt, according to a few reports I've read. If they're bringing back part of the production in the U.S., it could explain why capex is increasing, why they need U.S. Yeah, I guess if you're repatriating your dollars, you got to push up the U.S. dollar. You're not using debt, you're using cash to make the investment. That could explain the resilience of economic activity, taking cash they own out of the USA. I'm not convinced it can explain all, but maybe part of it. It has to go into something that's not a financial asset. Okay. I can get on board with a little bit of that. Passionate about investing and trading. Feel more myself doing it rather than my current job. I'm a dentist with a master's degree. But I don't like doing it for the rest of my life, as it's very stressful and not rewarding in my country. Well, it's bloody rewarding here. Let me tell you. I don't care to have the charter, but I'm interested in the knowledge. I've tried technical analysis, but I'm questioning its validity, as you should. prepared to go through anything to be a good trader investor, then that's education and discipline. You think taking the courses and studying the CFA curriculum is good for me? Yeah, I think it is. Bearing in mind I don't care about the exams. Well, you can buy the books on Amazon. Here's the thing, though. When you buy the books and you don't have the exam, you don't force yourself to internalize it the way you would if you had an exam, because you have nothing on the line. So you don't get as close to it as you really would like to. So I've seen this in university, where one university I was at, if you lived in the city and you were over 60, you didn't have to pay tuition and you could audit a course. You just audit the course. So you had some people from the community that were over 60, and they would audit the course. That means they don't do the assignments, they don't do the exams, they just get to sit in class. I always found that they just weren't as attuned as students who faced the reality of being tested on it. So they were more of a tourist than a hotel worker, if you know what I mean. So yeah, I get that you don't care about the exams, but the exams bring a level of honesty to the process that you have to that you have to live up to. So it does force you to engage closer to it than you otherwise would. Okay. I'm waiting impatiently for your answer. I think, well, okay, you're in a different country. I think you meant to be, I'm waiting patiently for your answer. Or are you truly waiting impatiently, arms folded, foot tapping? Come on. Doing that kind of thing. Going to Panama, please stay safe. Oh yes, street crimes are extremely high in big cities. Every big city. Walking down the streets generally ill-advised in Panama City. Same with Detroit. Same with Baltimore. Same with Philadelphia. Same with Washington. I can name you off the top of my head 10 cities in northern U.S. that are just not safe to walk down. East Cleveland. There's another one that just popped into my head. I'd opt to take taxis, Ubers instead, even for relatively small distances, or make sure you rent a car or something. Some places like El Chorrillo is best avoided altogether. Yeah, and if you're in Detroit, just stay the hell away from 7 Mile and Greenfield too. If anyone listening knows that location, you know exactly what I'm talking about there. Avoid East Cleveland, especially there's one neighborhood there called Huff, I think. Avoid that altogether. In Toronto, I think there's one neighborhood, I forget the intersection of it, James and I don't know what, but avoid that one altogether. Every city has those neighborhoods where you just stay the frick away. I mean, just stay away. Definitely avoid going City of Cologne. Yeah, that's way on the Pacific side. I'm in Panama City, way on the Caribbean side. Let's see. I find that when you're in cities like that are known for violence and things like that, that if you mind your own business, they mind their own business. Most criminals don't want anything to do with you. You know, if you stay out of their way, they stay out of your way. They really, truly don't want anything to do with you. Still, though, prudent advice. I would not, at 11 p.m. on a Friday night, walk through, around the neighborhoods of 7 Mile and Greenfield in all my whiteness. I would not do. I'd probably get a bullet at some point. My guess would be that money's indeed going into the money market, but the Treasury supply is large enough to absorb the demand. Yeah. Well, we do see money flowing into money markets every week. I found your title, U.S. debt is no big deal, so my question has been answered. If interest rates stay as high as they are, it could become a talking point that then becomes an issue because it gets a life of its own. One of the things that we have to look at, like when we look at companies, we look at net debt. You know, like I just finished Freeport, and I just finished uploading Freeport for the Applied series. Freeport has $10 billion in debt. but they have $8 billion in cash. So if you net the two out, you get $2 billion in net debt. Now that $8 billion is earning the money market rate, 5.5%. And their rates on their bonds, which were issued before interest rates went up, are sitting right around that yield as well. With the U.S., we look at their debt. Oh, the U.S. has this much in debt. Yeah. How much of it is held by the Treasury, right? They cancel each other out. How much is held by the Treasury? How much of that debt has gone to agencies who then issue debt? So how much of that debt is earning a yield on the other side of the balance sheet? So when you just look at debt, Freeport has $10 billion in debt. Come on. No, they have $2 billion in net debt. We don't do that with the U.S. government. It's like, sure, they have that much debt, but what's on the other side of the balance sheet, right? Let's look at the other side. What do we have over there that's generating income? Oh, but the debt on the interest rate on the debt will be this much. Yes, but if that debt was used to push other debt out somewhere else that somebody else is paying money on, then they're earning that much on the other side as well. We just don't have a balance sheet for the U.S., so we don't know what assets they have, but we can't discount that. They do have assets. So, looking at one side of it is missing the other, is missing the bigger picture that some of that debt went into productivity enhancing investments. Some of it went into loans that then went out to, whether it be farms, whether it be to banks, whether it be to whatever they lend money to. But some of that money was borrowed from the public, and then the institution that borrowed it, well, then they lent it to different organizations to help them get a better lending rate than they would through their local business. So we have to count all of that stuff, right? Student loans. Well, when they start paying that back, there's an interest rate on that. That is owed. That there's debt. That's part of that big number that everyone looks at. But 1 trillion of that is owed by the students who have student loan debt. Well, they pay an interest rate, which then pays the interest rate on the debt that was issued to finance that debt. You have to try to balance that out. If only the U.S. government were forced to actually produce a balance sheet and not just a list of liabilities, right? You argued that you can't look at U.S. debt without looking at its assets. Oh, I should have kept reading. There we go. I was wondering if you have any good studies that do this and evaluate the solvency position of the U.S. Again, that is something that you just really can't. You can't look at the solvency of the U.S. per se, simply because of its taxation and money printing authority. So it is at any given time solvent. It is at any given time solvent, and if you find it to be insolvent, just walk down to the mint and say, we're going to need this, and it's not insolvent anymore. It is at all times solvent, right? Keep in mind, the U.S. owns everything under the ground. Everything that's pulled out of the ground, there's a royalty. The U.S. owns all the air above your head. All the air above your head, and they sell spectrum. They own all the water that's around there, and all the water everywhere. They own every road, they own every highway, they own every bridge except the ones that are privately owned or whatever the case is. They own all the national parks. They own all the real estate that their buildings are sitting on. They own all the real estate that their libraries, all the public libraries are sitting on. The government is probably the single largest landowner, period. And the number of businesses that they own. So, yeah, you got to really look at both sides of it. If they had to give a balance sheet, I think the view would change. When you buy a share of TLT, how is that priced? Is the sum of the underlying bond? Oh, it's just net asset value of whatever it is that they're holding. How is the current price of 95 calculated? Take everything they hold, whatever that amounts to, divide by the number of shares of TLT that are outstanding. There's where you get your price. Flowing into short volatility ETFs or high. Yeah, maybe. Yeah. Thinking of doing synthetic long position on TLT. Avoid a U.S. withholding. How would I do this in a TFSA account? You would not, because you can't sell a put. And it's questionable whether you can actually buy a call in a TFSA, since cover call would require me to own the underlying. Are strips bonds treated differently than normal bonds when it comes to tax and withholding? Yeah, I believe they are, because they don't have a coupon. Is there any reason why I shouldn't do a synthetic instead of buying an equal amount of shares? Well, the synthetic, as I already explained, will be priced on the forward curve, so you will have carry, negative carry. The Evergrande situation, well, that was bound to happen, right? I mean, what is the sheer amount of the debt that they have? I mean, it's not in the, you're not talking about 5 billion or 10 billion or 15 billion or 20. It's huge. How does that affect the U.S. and Canadian market? Yeah, well, I think it affects anybody who owns the bonds. I don't know that it affects the markets. If it did, it already would be doing it. Knowing your investing is changing due to your move. It's shifting. I have to basically put it this way. Because of my move, I have to step aside for a bit and then step back in. I'm just stepping aside. What strategies will you continue to carry out normally? What strategies will be postponed? Well, I can't open new positions. It doesn't make any sense to open any new positions right now, especially in the Canadian market, knowing that I just have to exit them. And it's a shame, because some of the Canadian apartment REITs are starting to look good. Interrent and Minto are coming down in price, and they're not going away. They're not going away. I think they look good, but I can't touch them. I'm told by my accounting firm that I can keep my TFSA and my RSP, and I had moved those to cash, thinking that I had to liquidate them, and I thought, why not just do it now? And they said, no, not for those. So I may move those into Canadian apartment buildings. You had said you'd be interested in pullback in home builders. Is this the pullback you would be buying? No. I want to see DHI mid-90s, low 90s, maybe even in the 80s. I mean a pullback. And I don't think this is enough. But as mortgage rates go higher, fingers crossed. Do you have an opinion on if railroads are a good long-term investment? I've never really looked at railroads. Maybe it's something I should do in the bottom-up series is do an analysis of railroads, because I've always been curious about them, but I've never really looked into them. What mechanism sets the coupon amount for treasuries? The auction. And they're issued, when they're issued very pretty much at par. So whatever the yield was, usually sets the coupon. Usually they're issued at par, which is why you have a par curve, right? Okay, I did see this one. This one seems to be a parody, sort of comedy. I don't know if they're making fun of conservatives or making fun of liberals, but there it is. Maybe U.S. strength is not as much about other currencies' weakness as about selling duration and stocks, which increases demand for USD. I don't know how. I modify your question as where the money will move next. If I had to bet, I'd say USD strength would be short term, and treasuries can make a bottom next, maybe after a whoosh. I missed that chapter with the terminology. I guess I'm just not following that one. Slowing in existing home sales is good for REITs. Yeah, I think so, because if you need a home, where are you going to go? If you can't buy one, where are you going to go, right? Good for apartment REITs. Let's just narrow it down on that. I didn't see coverage of SPY for the past 2 weeks. I'm doing it with the week ahead, this week in earnings, rather than looking at the chart. I just don't know what value there is in looking at the chart right now, because the market just doesn't seem to really care that much. I think there's a problem, and my position that I had Just didn't work. And then once I gave up, since I've given up, the market's down to what, 260? I can't even say it. 260 points from when I gave up. Let's see. What do you think is causing real yields to increase? Well, all yields are increasing. All yields are increasing. That's the curious thing, right? All yields are increasing. S&P is going down. Small cap stocks are going down. U.S. dollars going up. Me scratching my head. Yeah, this is part of the puzzle. Where's the money going? Lots of money going. I can't intuitively see it. You and me both. What's your opinion on Bridgewater's liquidity hole piece? I didn't see it. Don't chase happiness, find meaning. If you'd be willing to share what has given you meaning. Oh, that would be a separate video altogether. I think I'm going to end here. Let's do a couple more, and I think I'm going to end. For a while now, Fed minutes have been talking about the restrictive monetary policy regime we're supposedly in. It seems to be based on the idea that 2 to 2.5% is the long-run neutral rate, given that long-run inflation hovers in that range. Okay, but with GDP now near 6%, isn't that wild? 5.8? This assumption seems very questionable. Yeah, or the GDP now model is flawed, right? Does it really make sense just to match the Fed funds rate with the inflation target like this? I don't think anybody really knows what the neutral rate is, and I don't think it is a rate. I think it is all context specific. I think that it is a rate, that there is some level of the rate, and no one knows what it is, and I don't think it's constant, but I think there's some level of the rate that is neutral, but it depends on what's going on, right? So I don't know that there is a number that we should shoot for in an absolute sense. I think it's all relative to whatever context we're in. In the past, we've seen long periods of expansion with rates much higher than they are now. Under 7 to 10% rates, we were seeing bull markets without inflation spiking higher. And back then, the economy was more sensitive to rates. How could 2 to 2.5 be neutral now? Well, we live in a much more globalized world than we used to. You go back to the 80s, there really wasn't that many options of where you could go, right? There just wasn't of where your money could go, not like there is today. Today we live in a world with a lot more capital mobility, a lot more global integration, and a lot more alternatives of where we can go and what we can do. So it's I think a more deflationary world than an inflationary world. And my God, we shut the economy down and opened it back up, and we were shocked I say, that not everybody opened up at the same time and created supply chain problems. Well, duh, right? So previous to that, the 15 years, 10, 12, 15 years before that, it was deflation always on everybody's mind, saying, like, inflation's so low, and interest rates were at zero. So it is, in the beginning it seemed to be extremely supply driven, but the longer it's supply driven, the more it becomes demand driven, because it gets embedded in wages, which, they get more money, then they start spending more money, and then off to the races you go. Utility sector video uploaded sometime next week. I just finished Freeport. How much have we got here? Oh, we're almost done. Let me get another couple out of the way. Ever been to Europe? Russia, Portugal, or Spain? What are some decent ways to get exposure to Canadian home builders? God, you tell me. I've tried to find a publicly traded Canadian home builder. They don't exist. They don't exist. I don't know. Okay, so this is not a question here. I'm sorry I'm not reading it. It's just that I'm I don't want to wrap up here soon. Justin Castro will miss you. Well, both Justin and what's our other guy's name? Jagmeet. We have two prime ministers. I did answer all these questions about the theta. I did answer them in the comment section. Let's see. I did answer this as well. Size of the positions you hold. I'm confused why that song resonates. I didn't say it resonated with me. I said I understand it, but it doesn't resonate with me. I don't say, oh yeah, that's me. That I don't see myself in that song, but I do see emotion in that song. And when you look at the comments section, you cannot ignore the crowd. You can disagree with the crowd, but you can't ignore the crowd. And this is a worker song. This is an anthem for a workers' revolt. This is, so many people who feel that their government has simply just turned their backs on them because they're not, let's say, one of the popular things to care about these days. The bandwagon's not driving by with a bunch of poor workers on it. That's not a realistic or enough of a gripe. And especially if it's poor white people, it seems that they got the short end of the stick over the last 5 or 6 years. So it's, you can see it resonate in the comments section. It's not that it's resonating with me. I don't see myself reflected in that song. But I can recognize when something is important, even if it doesn't reflect me. I can recognize when something's important, and the song is not important as the reaction to the song. That's important. Let's see. The artist will become new Joe the Plumber in the upcoming election cycle. Once certain net worth is met, one can become politically agnostic. No, that's not true. That's not true at all. Mentioning leftists as if it matters, and it does. Markets move regardless of political leadership. Yeah, but you can't just, I don't just live in a market. I live in a society embedded in a political system with certain levels of sticks and carrots that are thrown out. And when you disagree, when you have nothing but sticks and they forget about carrots, there are no carrots out there for people to say, yeah, I should stand up and do this. I should stand up and do that. It's like, no. We'll hand you stuff. For example, and you can look this up. This is a true thing. It is not important in Canada to get people off of heroin. People are dying in the streets. Heroin overdose. Cleaning that up's not important. What is more important is making sure they don't die from a heroin overdose. So let's give them a safe injection site so that they can live to inject their heroin another day. Let's make sure that they stay alive while they're injecting their heroin. And I know we'll get the taxpayer to pay for this. Let's not fix the problem. Let's just fix the problem of them ODing. And our tax dollars go to pay for that stuff. Now, the argument I've heard pushed back is it's much cheaper on the healthcare system. You know what else is cheaper? Not arresting criminals. As soon as you arrest a criminal, you got to pay for them to be in jail. It's cheaper not to arrest them. Why don't we do that? Why don't we all do that? Why don't we say, listen, for these people who are doing break and enters, theft under 5,000, armed robbery, even armed robbery, 20 years in jail. That's expensive for the taxpayer. It would be cheaper to just let them go. Why don't we do that? If we say that, hey, listen, it's cheaper on health care if we make sure that they live another day to inject heroin. Let's use taxpayer dollars. Look, we got to use taxpayer dollars for prison. It's cheaper if we let the break and enter person go. So that we don't have to support them in prison, because in prison you gotta run that prison, you gotta hire the guards, you've got to feed that person, clothe that person, dental care, health care, you gotta provide all that for them. That's expensive for the taxpayer. See, this is why I don't like that argument. It's cheaper. That's extortion. That is nothing more than extortion, right? It's like saying, let me do this bad thing to you, because if you don't, I'll do this other bad thing to you. So let me do the less bad thing, otherwise I'll do the more bad thing. I don't like that argument. You do have to, you live in a society like that. You can't just say, oh, look, I'm okay, I'm above it all, I got my money, the markets don't care, who cares? It does matter. It does matter. Enjoy your vacation, clear your head, and return the objective, fundamental driven person we know. I am objective. I am fundamentally driven. It's the market that is behaviorally driven now. I'm still fundamentally driven, but you don't want to be fundamentally driven with behavioral market. I don't know that I was saying, oh my God, I see myself in the song. I'm saying this to me seems important, too important to dismiss. And no matter how successful an individual gets, you are part of an economy, you are part of the body politic. You really can't just abandon and abdicate any kind of responsibility. If you have done well, should you not then help with society to show them how to do well, as opposed to more the leftist thinking saying, well, since you have done well, should you not give your stuff to other people who haven't done well? Left has no solution for how other people can do well. They only have a solution for how they take away from people who did well and attempt very badly to give to people who are not doing well, but they in no way try to help people do well. They're not trying to get these people off of heroin. They're just trying to make sure they don't die by giving them a safe place. There was even some talk about supplying them with a safe supply of heroin. I am not kidding you on that. You can Google it. Actually, you can't in Canada now. I think Google and Facebook block news because our liberal government has decided that our news organizations can't survive without being supported by taxpayer dollars, because no one's really that interested in it. So we have to support news agencies we don't want. They decided that, well, the tech companies should have to pay as well, and the tech company said, no, we're not paying for that stuff. And that was the end of it. Anyways, we'll end here. I don't think there was much left. Okay, all done.